Welcome back to Investing Talk podcast. We're jumping straight into a deep dive today, focusing on one specific company, the GEO Group. Our goal is to pull out the most important insights about its business, recent performance, financial health, the risks it faces, and what the future might look like. Think of this as your fast track to getting informed on this name. And hey, if you're finding these sessions valuable, please do remember to subscribe, like, and comment. It really helps. And if you feel like supporting what we do, considering buying us a coffee makes a difference. Okay, let's unpack this. The company is the GEO Group. What's the basic rundown?
Okay, so they're presented as a major player in private corrections, also detention, and community reentry services. Headquarters are down in Boca Raton, Florida.
Right. And how is their business structured? It seems like they do a few different things.
They do. It breaks down into four main segments, generally. You've got U.S. Corrections that's managing privatized facilities for federal and state governments.
Okay.
Then there are international services. They have operations in South Africa, Australia, and the U.K.
Interesting. What else?
There's GEO Care, which is more focused on mental health and residential treatment services, but within the U.S. And lastly, they actually handle facility construction and design, so building and designing these kinds of places.
So quite involved from start to finish, potentially. How does the core business model work? It's based on government partnerships, right?
That's a foundation. Public-private partnerships with various government agencies. And it's not just, managing the buildings. They provide rehabilitation programs, too.
Like what kind of programs?
Things like educational and vocational training, cognitive behavioral therapy, substance abuse treatment, even faith-based initiatives. They sort of package all this under what they call their continuum of care platform.
Okay, continuum of care. Got it. So managing facilities and offering rehab programs under government contracts. Let's shift to how the market views them. How has the stock been performing, let's say, as of mid-June 2025?
Well, looking at the past month, the stock has shown moderate volatility. It's mostly been trading sideways, kind of influenced by these broader discussions around potential regulatory changes in the sector.
Makes sense. What if we look back further, say, 6 months?
Over that period, the share price did have some upward momentum. That came after they reported what were seen as positive Q1 2025 earnings. But you will also see intermittent pressure popping up from these ongoing debates about private prison contracts. That seems to cap things at times.
Right. That policy aspect seems like a constant shadow. How about the full past year?
Looking back a whole year, there was a pretty notable rally late last year. That seemed to happen after investor concerns about their debt situation maybe stabilized a bit. However, the stock is still quite sensitive to political headlines, especially anything related to criminal justice reform. The information stresses there haven't been like huge single-day blow-ups recently, but investor sentiment is definitely cautious because of all that policy uncertainty.
Cautious sentiment. But I think there is a specific dip recently mentioned, June 13th.
Yes, that's right. On June 13th, GEO shares fell about 6%, closing in near $24.95. I think it touched $24.85 that day. And that move pushed the stock below its 50-day moving average, which was hovering around $28.
Okay, a meaningful drop. What was the reason cited for that particular decline?
It appears linked directly to their Q1 earnings miss. It seemed to reflect investor concerns about profitability, even though, interestingly, they had also announced some new contract wins around the same time.
So the earnings miss just weighed heavier that day, overshadowing the good news on contracts.
That's how it looks, yes.
Let's dig into those Q1 financials then, since they seem pivotal. What was the top-line revenue number?
For Q1 2025, revenue was reported at $604.65 million.
Yeah.
And it was noted that this was slightly below what the consensus estimates were looking for.
And did they give guidance for the full year 2025 revenue?
They did. The guidance is for approximately $2.53 billion for the full year. One analysis pointed out this was also slightly below what the market had been expecting.
So a slight miss in Q1, slightly soft guidance for the year. What's the overall revenue trend been like?
Recently, the trend has been relatively flat compared to the year before. Q4 2024 revenue, for example, was very close year over year. The company does anticipate growth picking up more in the second half of 2025, though. They mentioned some higher costs hitting early in the year that should ease off.
Okay, talking about costs, how did that flow through to the bottom line? Net income and EPS for Q1.
Net income for Q1 2025 came in at $19.6 million. And the earnings per share, EPS, was $0.14 per diluted share. This is where that miss really stood out. Analyst expectations were apparently closer to 18 cents or 19 cents per share.
Okay, so confirming that EPS miss was a key factor in the recent stock move, what's the full-year EPS guidance look like?
The projection for the full year 2025 is in the range of 77 cents to 99 cents per diluted share.
All right. Now, moving beyond the quarterly results, debt seems to be a recurring theme with this company.
It's a major point, yes. They've historically carried substantial debt. That's pretty typical for businesses owning and running these large capital-intensive facilities. They have been taking steps, actively working towards reducing that leverage.
Do we have a recent measure of that, like debt to equity?
A recent debt-to-equity ratio was reported around 1.25. It was noted this ratio has been higher historically, sometimes over 2 times, which really underscores that leveraged model. They ended fiscal 24 with about $1.7 billion in net debt.
$1.7 billion is significant. Is there a specific debt reduction target they've mentioned?
Yes, management has stated a goal to cut debt by $150 million to $175 million by the end of this year. Using proceeds from ongoing asset sales specifically for that purpose is seen as a positive for the balance sheet.
Okay, debt reduction is a focus. What about profitability and margins? You mentioned higher costs earlier.
Overall profitability is still positive. However, margins are described as being pressured by high operating costs. That's a common theme here. The lower than expected Q1 earnings really highlight those margin challenges. An example given was an 18% year-over-year increase in general and administrative, or G&A expenses, late in fiscal 24.
Got it. Costs are squeezing margins. Are there other financial metrics worth noting, maybe adjusted EBITDA?
Adjusted EBITDA for Q1 25 was $108 million, and their full-year guidance for adjusted EBITDA is between $460 million and $490 million.
How does that compare to their spending plans, capital expenditures?
When you set that against their planned CapEx, which is about $125 to $145 million for fiscal 25, it suggests they still have capacity for positive free cash flow generation. And that free cash flow, the cash left after operations and investments, is crucial for things like paying down that debt.
Okay, so cash flow is there. Any other valuation metrics mentioned? PE ratio? Anything like that?
Return on equity has historically been in the 10% to 15% range. On valuation, their forward price to earnings ratio, looking at expected future earnings, has been trading around 7 to 10 times. It's highlighted that this is notably below the industry average for similar companies or REITs, which might be closer to 12 to 18 times.
Why the lower valuation multiple?
That lower PE and also their price-to-book ratio trading historically below book value, maybe around 0.8 times, is explicitly linked to sector-specific risks. These include those ESG, environmental, social, governance concerns, and the significant regulatory uncertainty that hangs over the whole sector. Also worth noting, they aren't currently paying a dividend. That was suspended while they focus on deleveraging.
Right. The ESG and regulatory factors seem key to that valuation discount. Okay, let's pivot to the risks and strengths explicitly called out. What were the main red flags?
Several key ones were listed. First and foremost is that exposure to regulatory risk. Changes in government policy, federal or state, could really impact their contracts or just reduce the future need for private operators altogether.
That feels fundamental. What else?
The high leverage is still a concern. That risk gets worse if refinancing debt becomes harder or more expensive, or if their operating cash flows weaken unexpectedly.
Any legal worries?
Yes, ongoing legal challenges and the potential for future lawsuits are flagged as a risk factor.
And specific risks related to their actual facilities.
There's the risk of facility depopulation or needing to repurpose them. The Lee County facility was mentioned as an example, maybe seeing lower populations or even being sold off if client needs change or policies shift.
We touched on costs, but is inflation itself a named risk?
It is. Cost inflation pressures are listed, with that 18% jump in G&A expenses late last year used as a specific example of that pressure.
Okay, clear challenges. On the flip side, what strengths were identified?
A key strength is their diversified revenue streams. Having operations across domestic and international corrections, plus those community rehab services, helps mitigate risk. They aren't reliant on just one single area.
So diversification helps buffer them a bit.
It seems to. Another strength noted is their continued profitability, even with all these sector headwinds. That's presented as evidence of operational resilience.
And their position in the market, their competitive edge.
They're described as having significant competitive advantages. Comes from their sheer scale, the long-term nature of government contracts they hold, their specialized know-how in handling complex compliance rules, and also the high cost of building these kinds of facilities in the first place. It's a barrier to entry for new competitors.
So being established and experienced is a big plus here.
It appears so. They are positioned as a market leader in the U.S. and internationally within this private corrections and detention space.
That gives us a good handle on the internal picture. Let's zoom back out to some very recent events. There was mention of a court settlement and a big contract win around the same time in June 2025.
Correct. June 10th, GEO announced court approval for a recent settlement. The specific terms weren't detailed, though. Just before that, on June 9th, they landed a pretty significant new contract with ICE U.S. Immigration and Customs Enforcement.
How significant is that ICE contract? What are the details?
It's described as a $66 million contract to reactivate their D. Ray James facility, which they own. This adds 1,868 beds back into operation under a modified agreement. And this contract is noted as part of a larger effort, multiple facility reactivations that add up to over $130 million in annualized revenues across 2 contracts, covering around 2,800 beds total.
Wow, okay, that sounds like a substantial boost to potential revenue.
Good.
How did these things, the settlement, the new contracts, connect back to the stock volatility we talked about earlier?
Well, the information suggests that the Q1 earnings miss, combined with announcing these new contract wins, both influenced the recent stock moves and investor sentiment. The earnings miss seemed to have a more immediate negative impact, contributing to that price dip we discussed.
Got it. Were there any other commitments GEO made related to these new ICE deals?
Yes, it is mentioned they're putting $70 million towards enhancing their ICE service capabilities. This is seen as potentially positioning them better if federal demand for these kinds of services holds up or increases.
Okay. And thinking about risks again, we mentioned debt and refinancing. Do broader economic things like interest rates matter here?
They definitely could. Changes in interest rates could impact their financing costs, which is very relevant given how much debt they carry.
Makes sense. What about competition? Who are they mainly up against?
The main competitors highlighted are CoreCivic and Management and Training Corps, or MTC.
How does GEO compare to CoreCivic?
CoreCivic is described as the largest U.S. competitor and financially quite similar to GEO. The point is made that GEO and CoreCivic are really the 2 dominant players in the U.S. market.
And MTC?
MTC is noted as being smaller and also less diversified in its business compared to GEO and CoreCivic.
So GEO and CoreCivic are the big 2, facing similar policy and cost challenges. MTC is smaller. And you mentioned earlier both GEO and CoreCivic trade at lower multiples than typical REITs. Remind us why.
That discount is attributed again to those ESG concerns surrounding the industry and the significant ongoing regulatory uncertainty they both face.
Right. Okay, beyond the numbers and competitors, what's the general market feeling? Any other recent news?
There was news in June about GEO agreeing to sell certain assets described as non-core. Analysts generally saw this positively, as sensible portfolio management, not necessarily a sign of distress.
And how are analysts rating the stock overall?
Ratings are described as mixed to neutral. The reasoning often balances the company's stable cash flow against those persistent headline risks and regulatory uncertainties. Some analysts suggested maybe looking elsewhere for better opportunities.
What about chatter on social media like X? Any insights there?
Sentiment among retail investors, post-earnings and the contract news, seems cautiously optimistic. But there's also definite skepticism noted about long-term growth, specifically because of those political uncertainties. A lot of discussion focuses on the stock's volatility and potential downside risk if margins don't improve, like hoped with the new contracts. And of course, always verify social media info independently.
Good point. So a mixed bag of sentiment. Looking forward then, what are the key things to watch? Upcoming events or risks?
The next quarterly earnings report, expected in August 2025, is definitely highlighted. That should give more clarity on the impact of the asset sales and how those margins are trending.
And the asset sales themselves.
Yes, continuing to sell off non-core assets could be positive, especially if you use the cash to pay down debt, improving the balance sheet.
But the big one, regulatory risk, that's still front and center.
Remains highly elevated, yes. The potential for new laws or policy changes at federal or state levels is a constant factor. Could really affect future contracts.
And the broader economy?
Broader market conditions, government budgets, those could influence the overall demand for outsourced services as well.
Okay, so pulling all this together, the business model, the financials showing some pressure, the clear risks but also strength, the recent contract wins. What was the final summary recommendation offered?
The summary recommendation provided was hold.
Hold. And the main reason for that?
The reasoning points to the company's operational stability and continued profitability, even facing big headwinds like regulatory scrutiny and high debt. The asset sales are seen as prudent, and the diversified services offer some protection.
But there's a but.
There is. The persistent uncertainty from potential policy shifts is seen as a major overhang. It limits the potential near-term upside compared to the risks involved.
So stability versus risk. What's the takeaway advice for listeners then?
The advice is to monitor upcoming earnings closely. Look specifically for signs of improved financial flexibility, particularly debt reduction and margin trends, before thinking about a more aggressive stance.
This deep dive certainly highlights a company in a complex spot. You've got established operations, recent wins, but also significant debt and that constant shadow of policy risk. It really is a push and pull between operational stability and these major external risks, plus mixed signals from recent results versus new business. So here's something for you to think about. Given these competing forces, the stability versus the policy and leverage risks, how would you weigh them when considering the long-term path for a company like the GEO Group? What kind of fundamental change, positive or negative, would have to happen in this environment to completely shift your perspective on its future?